Buff, thank you very much for being here. It's a pleasure having you taking the time to be here. How's it going?
Doing great. Hey, thanks for having me on. These are unique times, so it's good to be on here today.
Do you think the market just basically was up like 1,100 points? We had all that earnings announcements that came out with Tesla and stuff like that, and everything is running side by side with it. What is a money? So what is a money manager looking at right now? Are they buying more? Are they getting out with it? What are you looking at?
Well, my approach is quite a bit different from most money managers. So, you know, most money managers they're fundamentally based, they're macro based. They may be quant driven, not a whole lot of that. I'm tactical, so I'm. Most of them are all reading from the same script. They all went to the same schools, read the read the same CFA course curriculum, so they all think kind of alike. I like to think as a charter market technician. I look at things through a different lens. I look at things through supply and demand, and basically my objective is to make money when the markets are moving up, but also preserve capital when they're down. And so that takes a tactical approach and understanding. And my so-called superpower, the gift that the good Lord has put in me, is I can follow the money. Okay, so I'm not the smartest guy on the street. Okay, I understand I'm not the smartest guy on the street, but what I can do is I can follow the smart money. Where is the money moving? And if I know where the money's moving, I can beat them to the punch because I'm not managing tens of billions of dollars, and so I'm much more nimble. So that's my approach to it.
Your approach is very similar to mine too. As being a day trader, trading, with Instinet and back in the day. I mean, how long you been doing this for?
So I think we started around the same time. I
Same
started
time.
in the markets in 1993, right around the same time as the first ETF came out, the Spider.
Okay. Okay. Yes, I started in '95, so you're right around the same time. You could. So back then, that's how I was traded. I was a market maker on Wall
Okay.
Street. Yeah, so basically we just follow orders. We follow the money. You know what I mean? Like you don't be the smartest person on the street. You just want to follow. You want to follow the smartest person on the street because they got more money than you. There's always someone that's richer than you and's got more money than you. So
Yeah, you're speaking my language. You don't have to be the smartest, but the wealthiest people, what they'll do is they'll hire the smartest minds, and then empower them with the best technology and equipment. Okay, so beating them is a tough game, but you don't have to beat them. All you have to do is be able to see what they're doing and then run ahead of them,
So
and
how do you see
that's the
them?
game.
What do you do to see them? Like we work on something called level 4. We look at the right of the chart. We look at
Mhm,
like we follow all the ECNs, the algorithms, the high frequency trades.
mhm.
Being a floor trader, you see these people on these screens. Like, what are they looking at? We're looking at. That's what I kind of teach. But what are you looking at that
Mhm.
kind of gives you that edge?
Yeah, so we're working different time frames. So I'm working with financial advisors
Okay.
that are building financial plans, and then from there we're trying to create successful financial outcomes using these analysis and tactics. So it's different. So when I'm putting my orders in, I'm trying to run against you because you're seeing what I'm doing, and I'm trying to manage the liquidity side. But to answer your question, but specifically I do, and this is my own intellectual property. But you can follow me on my newsletter or through my products. But what my intellectual property does is I can see the volume flow. So most people, when they look at, for instance, the S&P, and they want to know what the S&P's volume is. Okay, so as you know, there's three tapes: A, B, and C. Okay, when you
Hmm.
pull up S&P on your chart, more than likely you're not getting the S&P. You're getting tape A. Okay, which is the New York Stock Exchange. And what are the stocks that drive the S&P? Well, it's the Mag 7. None of those trade on the New York. So you're not even getting the volume on the most relevant tickers when you're looking at that. The other problem with volume is that it's tally. Okay, and so to give you an example of this, in Citigroup, okay, back in the financial crisis, before that, it was the 5th biggest stock in the S&P. Okay, going into the credit crisis. Credit crisis happens. Citigroup goes from a prominent stock to a penny stock. Okay.
Okay.
So basically, Citigroup had no attribution to the S&P 500. Okay, but what happened to its volume? It didn't.
Exploded.
It went up 10, 20, 50 fold. So if you pulled up S&P 500 volume, which was really the New York Stock Exchange, 20-30% of the volume in any given day during the credit crisis was Citigroup, even though it didn't have hardly any, like 0.001% of the attribution of the S&P. So what I've done is to get to your point, is I cap weighted volume. So what that does is it harmonizes volume with the indexes. And by looking at this capital weighted volume, we can then use volume analysis to track the trends of where the money is moving. Okay, we can do that on a volume basis or on a capital flow basis, which is the dollar, which is dollar volume.
Now, are you using an indicator on that, or like, did you build something? How you tracking the volume? Because I work exactly the same. And we look at volume. Like, there's some stocks right now I could tell you, and they were trading like 1 million, 2 million, and then like about 20 minutes from now, we're at 30, 50, 100 million. Like that.
Yeah. So what this is specifically for the indexes.
For the indexes.
Yeah. So this volume is indexed. You could use also one of my other indicators is my first indicator I developed was the volume weighted moving average. You probably have that on your charts, but that was my work back in the 90s, making it's like VWAP, except you can choose your points in time. It doesn't have to be intraday. So you can use a volume weighted moving average as opposed to just opposed to moving average. And what that does for you is really 4 things. First, volume leads price. Okay. So you're going to get quicker signals when you add volume to your indicators. 2, volume confirms price. Okay. So not only are you getting in quicker, you have a higher probability of making the correct decision. And if you can get in quicker and you can have a higher probability of being more accurate, then you can reduce risk and increase returns. Those are the 4 R's of volume.
I want to get back to your Citi trade back in the financial crisis. That was one of my worst trades I've ever had in my life.
Tell me about it.
I'll tell you. So I remember, like, let me tell you, that was a scary time. I don't know how you dealt with it, but that was like, it was really, really scary. I mean, every bank was going out of business. With Turns and Wachovia.
One day I worked for Wachovia, next day I worked for Citigroup, and the next day I worked for Wells Fargo. That was all in 1 week.
Oh my God, that's crazy. So anyway, get back to Citibank. I'm looking at the stock, and I'm like, I remember I was doing a lot of presentations at at expos, and people were like, where do you see Citibank? I was going to Canada, I was going everywhere. And I remember the thing was like, I own it at 18. I'm like, next support's at 8. And like, I mean, dropped all the way down to $1. And then this is one thing, talk about the volume. I'll never forget this, but like, and this is the good thing, a bad thing about being a day trader. I saw there was a 1 million share buyer on the bid, and he just kept buying it. But it wasn't $1. It was $1 and a penny. He didn't want to go under $1.
Yeah.
And he just kept.
Was that you? I always put a penny above so I can get it.
That's a big trick. A lot of people don't know that. Always sell a penny below and a penny above. So and he just kept refreshing his quote. He kept buying a million for about a quarter of the day. He must have bought, I don't even know how much he probably bought. He probably bought like me $50, $100 million worth of stock. And I said, screw it. I went all in on it. And then the next day it ran to $1.50 and I sold it. And I'm like, I made 50% on my money on it, but like, and I'm like, but you don't get those opportunities in the market. Like some of us dealt with it like COVID, we're probably dealing with one right now with the crisis that's going on with the tariffs. I mean, not as bad. but I sold it and the damn thing went to $5. And I
Yeah.
was so pissed that
Yeah.
I sold it. It was like, I would have made a killing on it, but it was a lot of money. But you know
You got
what?
to
Those
stick
are
to your
crazy
discipline,
times.
though, right? You got to. I mean, you got 50%. The only the only thing I would say is what I do is I often when I hit my target, then I raise my stop. So I make whatever my discipline is, I hit that target, then I raise my stop. Maybe I was looking at maybe you're looking at the 15-minute level, then you switch it to the hour level, and
Right.
so you increase your time frames to raise your stop. That way you can follow a move up, and when you're already locked in so much profit.
Yeah, that's a good strategy, because there's a lot of people that are listening in right here are just still learning and they don't, are still trying to, capture, understand. We watch on financial stations, you hear analysts like you and money managers, and they're just talking just way, way over their head on like, oh, I'm looking at this, looking at that. But like, what is your strategy? Like you said, how do you uptick and get prepared? Because one of the big things I teach, Buff, is like, I try to focus on teach people not how to make money. I teach them how to stop losing it. That's the
Mm-hmm.
biggest issue. Winners, they
Oh,
take care.
you,
Yeah.
yeah,
Those things.
that's you and me are right on the same page. I
Yeah.
mean, you got to play, you got to know how to play offense, right?
Right.
Okay,
Well, that's
but
why you got
it's
hired. You are
but
offense. You know what I mean?
but defense,
You
it's
want to lose the
defense that
game.
wins championships, right?
Exactly.
Because if you got a good defense, you're always in the game. All
Right.
right, and your capital, that is your firepower. Okay, that is precious. Okay, and so you think about it. If you lose 10% and then you make 10%, you're still down.
You're still
Okay,
down.
if you make 20%, you need 25 to get back to even. Okay,
Just to
if you
break
lose
even.
half your principal, then you got to double it to get back to even. So if you keep those losses small, you know how to play defense. Hey, you're in the game, and it makes you preserve that capital base. It makes it a lot easier to compound.
So Buff, being around for so long, we've all went through this, and I want to ask you a very personal question. A lot of people ask, well, I mean, we all have lost. We always made mistakes. How did you dig yourself out of being a money manager and not getting yourself in trouble? Because there's a lot of people here that listening in get into that situation, and I mean, I know the answer. One of them was like, sometimes they go all in on certain things and whatever. They don't get too diversified. But like, have you ever been involved, and how'd you dig yourself out of it? It has ever happened in the market over the years, because we went through some really bad catastrophes. If it was the internet bubble, if it was COVID, if it was the financial crisis, ever happened to you?
Well,
Anything stand out?
I'm thinking of a situation where it happened to me, um, and and so I'm thinking about 2000. Okay, so 2000, we had a market that particularly, like, I at that time I was I was the portfolio manager for a family office. Okay, and the president at the time was on vacation, and what happened is that I made a very bold call. At the time, I was just hitting it, man. I was calling everything, and then I made a very bold call, and I said 2 weeks before the crash, we're gonna start selling. We're gonna start raising cash. And you know what happened? That market gapped up. It went boom, boom. It was a blow off top, and the owner of the company was ticked that he wasn't making all the money that we were before, and we were killing it before. But he was so greedy about those 2 weeks that we were missing out on. Then the
Right.
market started to fall, and I got a call from the president. We're pulling your stops. We're losing. We're and we saw the market just tank, and while they bought back in at the high, and then it took all my stops out. So I felt that pain, and that was awful. And that's one that you is so hard to dig out of when the market has a significant pullback. It looked a lot worse actually than what we just went through. If you but this market is very reminiscent of that 99, 90, 88, 98, 99. There's a lot of, the market isn't the same, but it rhymes. And this market rhymes really well this AI bubble is very similar to that .com
The dot
bubble
com bubble.
of the 90s. A lot of similarities there. But that .com bubble, it was in my opinion, a lot worse than what we've been feeling here recently.
Actually, I think I remember that day.
Mhm.
I remember the Nasdaq dropped like 800 points in like 2 hours, and but it wasn't like at these numbers. I mean, I think
Yeah,
Nasdaq
the
was trading at
percentages
like,
were a lot higher.
yeah, like percentage wise, it was dropped like almost like 30% in one day. It was the most craziest thing ever that I've ever seen. And then we had that big rally that came up with it. Stops were getting taken out everywhere, and like it was like a day trader's dream. But like for somebody like you, and when you're not looking more of an active trader, you're looking like that. I mean, I could imagine your boss going crazy. But it is a lesson learned, and I tell everyone, it kind of teaches everybody a lesson. This is why you just don't sit there and set it and forget it, because you can get yourself crushed on that,
Yeah,
But
yeah. I'm not
yeah.
saying that I haven't made a lot of those mistakes, but that one particularly reminiscence in my mind. That certainly comes to mind.
So how do you deal with this market right now then? I mean, you being a money manager and trading for billion-dollar hedge fund and managing all that money. I mean, like, how do you guys actually prepare? Because this is like the most craziest roller coaster. I mean, up 1,000, down 2,000, up 3,000, we're down 1,000. I mean, do you sit back and we'll see where the chips fall and then step in?
Yeah, that's what most people do. But that's not my approach. So I'm again following the money. And what we noticed when we followed the money is that if this started to occur in right around June, July of 2024. And what we started to see is that massive amounts of capital were being exchanged. Okay. And at the same time, the market really wasn't going up or wasn't going down. What we were seeing is rotation. Okay. And so I write a letter and I changed on my updates the title to and then there were none. And what I was calling for was that this Mag 7 movement is going to wind itself down. Okay. And that was the thesis. And what we saw since that period of time, the market continued to go up, but the capital flows kept on drying out. So that leads us all the way into early March. So March 11th, my capital weighted dollar volume on the intermediate trend, it broke down. And so in my work, when the capital volume or capital dollar weighted or capital flows break down, that means that we're in a volume analysis bear market, or excuse me, correction. And so we started raising cash. By the
Okay.
25th, dollar volume or capital flows also broke trend. So we were in cash by the 25th.
I'm looking at
And
that right now when it had that crash.
yeah. And then what I look for is a setup to get back in. Either I want the trend to change or I look for a setup. And that setup is looking at the volume of retail investors. Okay. And so where do I find the volume of retail investors? It's a 3-letter symbol. You want to guess what it is? SPY.
S&P, SPY.
SPY.
I was gonna say
SPY.
FTX.
Okay. SPY is where the retailers, the retail trade goes. Okay. So we're not looking at the volume of the S&P, but the spider where the retail. This is where the people that buy on greed and then sell on fear. That's the vehicle they use. So you look at the QQQs or the spiders. That's what we want to look at when we want to identify capitulation. And so what we saw during that sell-off was the volume of the spider or the Qs. It started going up 10%, 20, 50, 100%, 200%, okay, on those instruments. And while the market's selling off. And what I look for is for that to start to subtly die down. When that subtly dies down, that means that those people have capitulated. It's time to get back in. We got that signal on, I believe it was April 11th. But what happened on April 9th? we got a 10% move in the S&P in one day.
I know. I'm looking at that right now.
I
April
didn't
9th, we
catch
had
I didn't catch the very bottom. That was a very unusual sign. Normally we're in before that, but this time the market already went up 10% before we were able to get back in.
It was up
Or
like
close to
3,000
10.
points that day. I'll never forget that day. And then we had that crash again. It's been very volatile. You know what's so funny? Like I'm a little old school. I know you're right. Everybody, you look at the retailers, they'll look at the S&P, SPY. They always look at the spiders. I don't know. Do you guys look at the Dow at all? Because I still use the Dow.
I really don't look at the Dow at all. I
Yeah.
don't. Mm.
I'm like
Um,
old school a little bit. I keep
mm.
looking at it, and you're right. I mean, like, because obviously you got
They
the
keep on
500.
changing the membership, and it's an average. So certain stocks have significantly more weight than others, and they can drive the whole thing. So
And there's all like what, 40, the top 40 or 30 or something like that.
yeah. So I don't even watch it, but it may be good. But I just kind of gave up on it.
Yeah. Okay. Now regarding so what is the responsibility of a money manager? What you do? I mean, what's why? I mean, there are people here have one. What makes you any special than them doing it themselves? I'm just out of curiosity. Some people probably ask.
Well, most people don't have it. The standard case is most people don't have the stomach to do it. All
Yeah,
right.
exactly. There you go.
So the when you have instruments like buying indexes and things like that, it makes how do you add value? Okay, so generally when you're a money manager, you have some sort of discipline. Maybe you're a value manager, maybe you're a growth manager, but maybe you do quality. It's these different subsectors where you try to follow different disciplines. So it's hard because you're up against a capital weighted index that can that when things are working out well, it does very well, and most of the time the market's doing well. So it's a tough job. My where I add value is providing what I just described. I'm going to try to find where the money's moving. Okay, and that's where we're going to be on offense, and then I'm going to provide this defensive safety net so that we can reduce risk, and then have that special team so that we know teams is transitioning from one to the other. Okay, how do you transition when you're on defense? How do you get back to offense? Okay, generally you don't want to do it after that 10% move, right?
Right.
But there's opportunities that that where your special team unit comes in and gets you back on the field. Okay, so basically, as a professional money manager, what I'm really trying to do is provide um, um, outcomes that are goals based. All right, so I'm trying to create successful outcomes that are goals based, and most of the money, where it is, it's in the distribution phase now. Okay,
Okay.
people are saving money, but now that more and more people move in retirement, they need to use that money to live off of.
To live off.
And so if I can provide maybe a slightly better return, give them better alpha with significantly less risk, less drawdown, then then those people are more likely to have a successful financial outcome for their planning. So if they didn't, if you lost 3% during this decline versus 17%, that's a big difference
A lot of comeback.
when you're spending it to live off of.
And by the way, you wrote this in your book. You have a couple of books out, don't you?
Yeah. My first book was Investing with Volume Analysis, which is really about about how do you analyze markets and securities using volume. The second one is how do you take that information and use it to produce these successful financial outcomes, like in financial planning.
And you have a new book that just came out, you
Yeah,
said?
that's the volume factor.
That's
Okay.
the volume pack. And by the
Yeah.
way, if anybody here wants to get that book, we're going to post a link up there, or you got the QR code in the top left-hand corner. If you just scan that with your phone, we'll get it over to you, and where to get that link and how to get that book from Buff. Because listen, it's knowledge is everything. Now, regarding about, there's a link right there if everybody clicks on it. and then got the QR code on top left hand corner. So how does someone go about finding a money manager? Because when I hear money manager, I hear like, oh, I need $500,000, I need $1 million. I mean, like, is there a specific number that someone has to come up with to have a money manager,
Well,
or just because there's
well,
people out there?
there's a couple different types of money managers. So if I think what you're describing is more of a financial advisor, and financial advisors have different limits, um, and and a financial advisor should have more of a broad, they have a more of a broad mandate, and that is to, and most of them are using what they call goals based financial planning. That's where they ask you about what do you want to do in life, okay, and then you monetize that and make sure that you build a portfolio that can achieve those very specific uh, those are very specific goals. Okay, then you also have to model it so that that you're within the client's risk tolerance, so that if markets like we've just seen they don't sell out when it's down. Okay,
Correct.
and that's really that's one of my biggest clients, is making sure that I give those advisors products that deliver those successful financial outcomes. Okay, and again, I think it's all about managing risk. Okay, like, and then there's like ETFs. You can buy ETFs for as little as $20-$25. All right, and that's a professionally managed product. Okay, you just can buy that at Fidelity, you can buy it at Schwab or wherever your brokerage. You just buy the ETF, and that is a professionally managed investment that that's very tax efficient, and is where someone is using, usually most of these are index based, so you're using some sort of analytical approach to invest it, as opposed to being discretionary.
So let me ask you something, because I know a lot of traders here are probably getting the same thing, because we trade a lot of ETFs. You're obviously an expert ETFs.
I manage two of them. So.
Okay. So, okay,
Mhm.
I know that, but the reason I'm asking that is because what in the hell happened to ETFs? Because when I started, it was a basket of stocks. Now you're getting ETFs that like Tesla has. I mean, I can't even imagine how many ETFs are out there. They're doing double shorts. They're doing it on the options. They're doing it on everything else. I mean, there's just so many ETFs now. So what separates one ETF that you're talking about, managing an ETF, than all these ETFs that are doing it on specific stocks like Nvidia and everything else? I mean, now they're all. I do a lot of presentations for Nasdaq, and I help do presentations with them, teaching them how to use their Nasdaq book viewer, how to trade on it.
Mhm.
And I know one of the reasons why they love to come out ETFs, because that's how they make a lot of money. You know what I mean?
Mhm.
So it's like coming out with an IPO. I mean, to come out
Yep.
an
Mhm.
ETF, they make a lot of fees on it and everything else. But what's going on with all these ETFs now? And
Okay.
what is it?
Well, the market is moving to ETFs because ETFs provide the best and most efficient tax structure. So if
Is it
you
a tax
own,
thing then? Is that what you're saying?
yeah, it's a tax advantage, because inside, if I owned all the stocks outside my ETF, and this is one of the reasons I created an ETF. Okay, I manage a very tactical and active strategy. My turnover is 400, 500% or more a year. If I'm running that outside of like an ERISA account or a foundation or a charitable account, that means I'm paying taxes on all those, on every capital gain that I have. Okay, I can do that same thing inside an exchange traded fund, and there's virtually no tax liability. Okay, I can make those same trades inside that ETF wrapper, and they're in, like, I could sell out of the market like in March and then move back in, didn't realize capital gains. All right, so that's a huge advantage if you're in a mutual fund, or if you're trading, or if you're doing a separately managed account. All those activities would be taxable, outside of like an ERISA, an IRA or a Roth or something like that. So that is a huge, absolutely huge advantage of an exchange traded fund. And that's why the money's moving from mutual funds to ETFs. Mutual funds, they're, you know, they're on their way to extinction. All
Are
right,
they really? I didn't
there's
even
no
know that.
reason to own a mutual fund when you can do the same thing in an ETF. There's two kinds. There's really, I'm going to break it down into two types. Okay, there's an index ETF. Okay, and then there's a discretionary ETF. Okay, and they both have different rules, but
Okay.
most ETFs are structured as an index. Now, my ETFs are, and I'm not here to promote those, but they are. I'm just saying they're super complicated. There's lots of different rules and triggers and analysis techniques that are going through, but it's all data driven. It's all algorithmic, and because it's algorithmic, even though it's moving in and out of the market, it's switching stocks all the time. Um, it is an index because it's
Okay.
algorithmic. Okay, most ETFs are algorithmic. Okay, and that's now there's some that are discretionary, like they're like maybe the ARC funds or things like that, where you have somebody actually pulling the trigger. But most of them fall under uh, that algorithmic um, um, category. Okay,
So then what about how does a specific ETF work on a stock then?
so all right. So there's some rules that you have to that are applied. So to get that special tax treatment, and one is that it has to be diversified. And so what I expect is what they're doing is to get, and I don't manage single stock ETFs, but they most likely are buying a bunch of derivatives on the same thing to get that supposed diversification rule. I
Okay.
think that they're kind of taking it a lot further than what when they structured the ETF environment or the rules in the early 90s. It's going, I think, way past that when they're doing these single stock ETFs.
I'll give you an example, Buff. I mean, I own a stock right now. I mean, I did really well on it. Let me tell you, TSLY.
Hmm.
Okay. So TSLY is an ETF, right?
Hmm.
It pays you. I mean, it got really beat up. I just bought it recently. It's the Tesla TCF. It pays you 150% dividend
Hmm.
on the stock. It pays you every month.
Hmm.
Now, obviously, if the stock goes down, I mean, yeah, one's washing the other. But like, there's that one. There's the one on Coinbase, CONY. There's Nvidia and NVIDIA. I mean, there's so many of them out there that it's just like I feel like.
Yeah.
I mean, I think Tesla has like 100 ETFs. I think they have. You know what I mean?
Yeah.
So I mean, it's not like back the old days when we used to do it. Like you had a basket of stocks and you wanted to trade like stocks that were the Fabulous Seven, whatever it is. I guess that's what you're doing more.
Yeah,
Is that right?
oh yeah, I'm not doing single stock ones, but those are just derivative products
Derivative.
that they use the underlying, and they use derivatives to to do what in the case of the one that you own, it sounds like they're probably writing calls.
Yeah, the
Uh,
writing calls on it, and
that-
then they have the one that does the short. That does the opposite on the short part of it.
Mhm.
And yeah, and that is just one because we have a lot of listeners in here that they just happen to find them and they're moving them, and we're just looking like what you're doing. We're here to make money, just trade it. But I didn't know that some of these people didn't know that if you do trade more of an ETF, is the tax that you said the tax incentive change if you trade it versus just trade a stock if you're
No, it's
mainly
so
an act.
different from a stock because you trade an individual stock. You got, and same with same with the ETF. You can buy and sell ETFs. You're paying capital gains.
You're
But
still paying capital gains,
what's happening inside that ETF is where you're getting the
the
tax
tax
benefits.
incentive.
Okay, so if you own a
Okay.
portfolio of 40 stocks and you have 100% turnover every quarter, you're not paying. If you owned it in a mutual fund, you'd be paying capital gains, and those would be distributed. So a mutual fund really stinks because you could just buy the mutual fund in November. They realized all these capital gains back in May, and you buy it in November, and you're still going to be paying that capital gains, even though you didn't even own it when they took it.
No,
It's
that makes sense. Now, regarding about the, just to recap here, just a couple of tips that I want to give the listeners out here. So, the mindset behind the whole thing. For someone just starting out to explore your methodology, what is the best first step? What should they be doing?
So there's a couple things if you're interested in my discipline, which is volume analysis. You could look at either one of my books, Investing with Volume Analysis, or the Volume Factor. The Volume Factor, what I'm doing there is I'm saying that volume is not only a leading indicator; it's actually a factor. And if it's actually a factor, how do you use that to create successful financial outcomes? So the first one's more about how do you do the analysis, and the second one is how do you use that analysis within building financial plans. The other thing you could do if you want to follow my work, and like some of the calls that I've been mentioning about how we've been moving from equity to cash and then back in. You can follow me on my volume analysis flash updates. And you can go to my website, buffdormeier.com, subscribe to that. That's free. And you can follow all my works. I've been talking a lot about the generals, which are or the Nephilim, which are the Mag 7. I've been talking about, the small caps, the troops. I've been talking about the brass commanders, which are more of your S&P equal weight, your dividend stocks, talking about how these different aspects of the market, how they're doing, how they're being positioned.
And with that said, now just before we go, one last thing. What do we do with this market? Like, do we still sit? Do we still let the chips fall? What do we do with the tariffs?
So the way I see this market is that when we got down to 4,800 on the S&P, okay, I think that we put a floor in there. So, and then when we broke support at 5,600, that's kind of the ceiling. So that's a huge trading range that we're in right now. Running through it is the old uptrend line, which right now is around 5,200, and that's steadily moving up. So that's running right out the middle. So we need to close this week right around 5,250 to stay above trend. So I'm looking at that old trend line that goes back several years. Right, it's running around 5,200. We want to stay above or below that, and within the big range of 4,800 on the bottom, 5,600 on the top. Okay,
if
we can break through either one of those levels, all bets are on or off.
Okay, so you're looking at. Yeah, I see what you're looking at. I see there's a lot of resistance levels just right above that 5,600, even going back in June, August, and even going into this month of March. So if we get past that, you're going to be very bullish. But if you think if we break,
if that trend line if we can keep above that trend line, which right around is about 5,200 or so, it's gradually going to rise to that 5,600. Okay, if we can stay above there, it's going to give us an opportunity at some point down the road to break out and go above. Okay, but if we fall below, we're still going to be in this super wide trading range. Okay, so that's kind of there's two scenarios. I don't try to predict what's going to happen. All I do is look at the data and try to analyze what it's telling me. Okay, so I'm not going to say what it's going to do, but I'm going to react based on what the indicators are telling me.
And is anything scary regarding what's coming out of this White House or anything else that you're looking for with these tariffs with China or anything that could affect it? Because like every time something comes out, it's like making this market rally.
Yeah, I was talking to a guy, one of the leaders in the CFA, as chartered financial analyst, and he's given a million different things, 100 different data points. I mean, he just kept on going more and more and more and more. Like, I don't care about that stuff. I don't care. All I care is about what people are doing. Okay, where is their money moving? I don't care. I don't care about any of those things. All I'm doing is looking at that data and making my decisions because it's all a bunch of noise. Everything that you're talking about is being priced in. So it's market is a discounting mechanism. It's taking all these things into account. The reason it went down, I don't think it's because of tariffs. I don't think it's because of interest rates. I don't think it's because of the tax plan. It's because people don't know.
Right.
It's uncertainty. Okay. They don't know what's going to happen next. And the market can take bad news. It can't take uncertainty. Okay, and that's where we're at right now. The market is adjusting to this uncertain climate. Okay.
And I'm following you, and I'm looking at it myself because that's where I'm at. But well, any last minute advice you want to give everyone, Buff, before we let you go? Because I really appreciate it. And by the way, everyone, if anyone has if they want to get his book, definitely read it. You had a couple of fans out there that already read your book already that are here. They love your book. And Buff, I know you very well known in the industry. You've been done so many presentations and done old TV channels. And
It was great to join you. Thank you.
You know,
and my last piece of advice: volume. Don't leave your chart without it.
And you'd be funny. You know what? When we teach so many people, they see it and they delete it. I'm like, you don't use the time in sales, or like you don't see the volume is everything. You know what I mean? That's why you and I felt we have a lot in common, because we look at action. Stop looking at the past. Focus on the future.
Yeah. You guys that grew up on the floor, you guys know it. Yeah, you guys get it.
Well, you guys didn't like me too much when we were younger. Like, what do you do? How did you get access to that? I just get so many fights with you guys at the bar. And like, hey, wait, who do you work for? Like, we were like, we took a lot of abuse back then because we actually spooked the market. It was like, we were always there. We were like those ants, so getting the crumbs on the floor all the time. But it worked out for all of us. But thank you so much for being here. Appreciate it. And everyone here, we're going to have some great shorts made up for this. Make sure you subscribe to the channel. We'll get these emails out to you. We'll get these on all our social networks. If you watch on YouTube, Facebook, Instagram, and if you have any questions, go out there, get his book, and enjoy it. Buff, thank you so much for being here. Appreciate it. And it's gonna be a hell of a roller coaster, I think, for the next month.
All right. Well,